Hi everyone, welcome back to Slevin Figures. It's been a while since I last did a video. It's been around actually 3.5 months to be exact. Been moving and doing a lot of things. Lost track of actually channel updates, but looking to get back at doing more episodes on a consistent basis. The last time we did an episode, this portfolio was sitting at $31,000. Today we're sitting at $44,000. I haven't changed anything in terms of style. I haven't changed anything in terms of consistency in depositing $50 in each one of these portfolios on a weekly basis. We'll go through each one of the portfolios, starting with the dividend portfolio, then growth, then Bogleheads. And one of the highlights of this episode today is the growth portfolio, which is now above 200% in terms of returns. This is in only 14 months of investing. Really incredible. When I first started this channel, one of the things I said was, you always want to be investing. The only loser in this world is the one that doesn't invest their money, makes it, spends it, or makes it and puts it in a bank account and hopes that one day they'll actually be able to retire and have money. So without further ado, let's jump into the portfolios. We'll start off with the dividend portfolio. Now, here we are on the dividend portfolio. Last time I did an episode, that was in like late July. This portfolio was in the negative, and it was in the negative by a significant amount. So around, I think, mid-teens negative return. Market's been roaring back up. Dividends have been getting paid out, and now this portfolio is at 15% return and $1,000 in the positive. If you look at the net cash flows here, it says $9,386. Remember, that includes the $360 that came in there as dividends. So we've had $360 in dividends, $654 in market gains, which is pretty nice. And it's good to see that the portfolio is overall in the positive. Now, going down here in the market sector, and this is, by the way, if you look at value over time, this is the highest this portfolio has ever been. Now, if you go down here on the sectors and try to review them, I'm going to take a look at what sector is high performing. So we'll look at the gains returns. And as we can see, alternatives are up 40%. I suspect that that's the private equity group's doing well, but mainly it's probably Albemarle. Albemarle is the lithium miner that I actually put in here. Technology is up 40%, no surprise there. Healthcare is up 31%. Consumer discretionary, the consumers are back, up 27%. Industrials are doing well at 20%. Bonds are not the best anymore at 15%. Communications is back. Finance is back. Most sectors are doing pretty well. Now let's look at the laggards. Energy, no surprise there. I'm still putting more of my money there, and that's why it's a high representation. If you go look at the S&P 500 today, the energy sector is probably less than 3% of that, the entire pie. In mine, it's 9% because I think it's been there's too much correction in that space. It's going to come back. We're going to get back to driving our cars, especially when we get this vaccine going. We're going to be looking to take vacations and driving out far. So I think that's there's an opportunity there to actually capture growth and get pretty high dividend payouts. Finance is the other one that you can see down here is 12% in my book, where it might be a little bit lower on the S&P 500. Just because I think the financials are going to do well. The banks, they kept their dividends. They're going to start doing buybacks, so share growth is going to go up while dividends are going to be maintained or even increased. REITs, never been a fan of them. Not surprised where they are. Not really going to change the allocation there. 7% is probably the maximum. Might even take that down to 5% eventually. So that's really it for the dividend portfolio. Overall, doing well finally. I always had faith that this portfolio will come back, and it has come back with a vengeance. It's got tons of legs in it. I think it's going to be above 25% in the next 4 weeks, just because a lot of these stocks were beaten down pretty badly. So we'll shift over next to the main event of this whole video, which is going to be the growth portfolio. So here we are in the growth portfolio, and I put in 200% in the title of the video, but we're at 236% return. This portfolio has been ridiculous, to say the least. It's doing phenomenally well. Net cash flows of $9,000 were put in here. Today, the portfolio sits at $23,565. Gain of $14,500, way more than what we put in. It's got a little bit of dividends in it, like $12, but that's from Microsoft, which is, I don't really care about it. So this portfolio is at the highest level it's ever been. It's performed better than I even expected, but not really too surprised. I knew that in the long term, this might actually be a better portfolio, but didn't expect all these returns to come in this early. There's only about 11 stocks in this portfolio, and that's why you see growth 11. That tells you how many stocks are in here. And as you can see, the pie, there's one, two, three, four investments now that kind of stick out like a sore thumb because of how much they've overperformed. And we're going to go through each one of these investments quickly. Not going to go deep in them, just to kind of show you why they've actually done well. So there's 11 stocks in here, and let's do the gain return, filter here. And Tesla, of course, is the biggest part of why we're doing so well. Tesla is up $9,200 based on the investment that we put in here. It's up 1,417%. This is also a large holding in my personal holding for retirement, and it's done incredibly well. It's outperformed all my retirement accounts combined. You have Invitae, which is up 362%. This stock went all the way down to $6 during the crisis, and I kept buying it when it was in a negative. And that's why you want to, if you believe in an investment, you got to average down and take advantage of people selling out of it. Because if you believe in the business, you have an inside track. You're not investing for the day. You're investing for the next 3 to 5 years. I'm going to keep this portfolio for at least 5 years, so I'm not worried about day-to-day gyrations. Go down to AMD, up 216%. This is another one of these large holdings that I have in my personal early retirement account. Uber, this kept going down, went down to $13 a share, and I kept buying it in this portfolio, just putting in $50 every now and then. Now it's above $50 again. Amazon up 82%. Google up 70%. I'll stop here and do it the other way. What are the lowest returners? There is no negative return in this account. Everything is positive. So the lowest performing stock is Beyond Meat, which is up 28%. Phenomenal company. I think it's going to do well. Facebook is one of the laggards at 60% after 14 months. Alibaba at 62%. The trade war with China has been holding this stock back a little bit. Netflix up 63%. And then Microsoft up 64%. Those are the laggards. So if you just go back to value and you go all the way down, all 11 stocks are either up 60% or more in the last 14 months. The main word that I always use with this portfolio is monopolistic. These companies are all monopolistic in nature in the spaces that they work in. Beyond Meat is yet to be proven, and Invitae, whether or not they're monopolistic, but the rest of these companies almost all dominate their space. Actually, AMD is also not yet proven to be a monopolistic company, but the way they're taking Intel's share and recent news with Apple moving away from Intel, this might be the chip company moving forward. And it might be pretty much game over for Intel. But the rest of these companies, Alibaba, Microsoft, Netflix, Google, Uber, Amazon, even Tesla in EVs, these are monopolies that people don't talk about, but they dominate their space and nobody's really close to them. So this has been a great portfolio. We'll see how it does moving forward. I'm still a fan of the dividend portfolio. I think it'll maybe not catch up to this level in the next year or two, but 4 or 5 years from now, value investing might be the thing that's in vogue, and we might see growth slow down a little bit. With that said, let's move to the last portfolio, which is the Boglehead Portfolio. So here we are in the Bogleheads Portfolio. This is the 2-fund portfolio and the one that I recommend to most of my family and friends who are not into investing but still want to put their money somewhere and feel like it's working for them and it's going to grow. Starting off here with the investment, current value is $10,463. Net cash flows were $9,247. Remember, that includes the dividends, which are $222 that came into the cash flows. The investment's up 21.4%. So it's actually higher than the dividend investment portfolio, which that portfolio took me a lot of time to construct by doing research on the stocks I wanted to put in there. This one took no time. Just picked 2 investments and I was done. Now, when we look at the pie, it's still remaining pretty closely 50-50 over here, close to the where I want it to be. So no need to hit the rebalance button. Value over time, as you can see, this investment is steady as she goes. During the crisis, did not really cause me to worry at all. The investment went down a little bit, but far less than the growth or the dividend portfolio. Then quickly resumed its growth trajectory after the crisis kind of passed a little bit. We're still in it, but it's stabilized and grown. What I want to show you in a second is going to really be revealing of why you don't need to do anything fancy and cute to actually do well as an investor. When we come down here and look at the 2 main investments in this portfolio, we have the Vanguard Total World Index Fund, that's VT. That covers all the stocks in the world pretty much. It has 8,000 different securities in it. If you notice, this investment's up 33.88%. That's better than the dividend portfolio by a mile, and not too bad compared to most investments out there. It's also beating a lot of the fund managers in the world. It's beating 80% of fund managers. So this is a really great investment if you want to be kind of aggressive without taking the risk of trying to get into a single stock and outsmart people. The Vanguard bond market, though, is up 9.24%. Also not bad. That's 10 times better than what Treasury is going to give you, or not 10 times, it's going to be about 8 times better than what a Treasury bond is going to give you, and 9 times better than what a bank account is going to give you, because right now bank accounts are giving you essentially 0. So overall, this portfolio is done incredibly well. The dividends are pretty good, not too far behind the dividend portfolio. Keep in mind the Vanguard Total World Index Fund has a payout ratio of around 2 to 2.4%. It's going to go back up once the European banks are allowed to give dividends again, because those got suspended during the crisis. As you can see here, I did get $8.23 from the Total Bond Index Fund. Once the $50 that automatically gets deposited in this account come in during the week, it'll get reinvested, more than likely actually in the bond index again, because the Total World Index Fund is outperforming it, and it's right now at 51.7%. That's one thing I like about M1 Finance, that automatic rebalancing is really helpful for tax efficiency. That's it for today's video. If you like the content, please hit the like button. Also, please subscribe.